Welcome to the Multifamily Investor Nation podcast, sponsored by CoStar, as well as RealPage, IMS software. We have with us today Sterling White. Welcome to the podcast here, Sterling.
Thanks for bringing me on. Those of you who are on here right now, super excited to bring you the absolute heat and fire. So get your popcorn ready and your notes.
Well, I'm excited about this one because it's definitely going to be a unique situation. We're going to talk about how you acquired this 156-unit property back in November of 2019 called Remington on Rockville out of Indianapolis, Indiana. And you actually found this one off market, so direct to owners. We're going to dive into that real quick and some more detail. But before we get started, Sterling, I want you to give the listeners a little bit of a background about yourself, and then we'll dive into this acquisition.
Yeah, so just to give you all an overview of myself, just a little quick Spark Note version. I'm born and raised in Indianapolis, Indiana, not so good parts of the city where you wouldn't want to walk your dog at night or even during the day. A fraternal twin brother, single mother, and grew up on government assistance, Section 8 housing, food stamps, and just the overall neighborhood wasn't the greatest. I just remember one instance where both my brother and I were sitting at one of these little multicolored little picnic tables. We were about 5 or 6 years old. And as soon as we go up from when we're finished eating dinner, a bullet goes through the back patio where we were sitting. So I may not be here, he may not be here, but decided to not be a product of my environment and use that as fuel. So got started in real estate 2009, construction side, fell in love with it, the industry, but not so much being a laborer. 2013, bought my very first deal, no money out of pocket. Actually had negative funds in my bank account because I overdrew it. Scaled up to 150 single families. 2017, shifted to multifamily. Very first deal was a 46 unit, and then scaled portfolio to just under 600 units, and have since exited out all those single families, and portfolio is just under 400 units, and valuation is just under 20 million. So not perfect by any means, and I'll be sharing the mistakes I've made and also some successes.
That's awesome. Well, I'm looking forward to diving into this one, and let's go ahead and do that right now. Most people that listen to my podcast are like, there's no fluff, and they just get right into it. So let's get into that, like how you actually found this deal and actually started to acquire this one.
Yeah, so my go-to strategy is just going direct to owner. What I've experienced is, and when that very first 46 unit deal, instead of going through had brokers sending over deals, they weren't even close to penciling out. So took the approach and said, why not essentially beat the brokers to the punch and then go direct to the owner? So my primary channel is cold call. And so every property is public record in terms of the information. So this particular property in itself, I use a database such as Reonomy, and I'll pull all the data from there. The apartments, 75 to 200 units. And then from there, I'll narrow down. I want workforce housing. So apartments that have rents between 700 to 1,000. So get zero-like focus, and that are, built? So about C-class assets. So built between the early 1970s. Then from there, I have my list and then start making the calls.
And so how long did it take you once you put this process in place to actually find, like maybe even just your first deal? Because I'm sure this probably wasn't the first one you had when you did that, or maybe it was.
So it took a while. So myself, I was making all the calls myself,
So
following up with the owners. No virtual assistants. Now I have since scaled that to where now there's a system in place. So I took what I did and systematized it, and then also documented and then delegated and trust but verify. So initially it was just me. I actually didn't do the side of pulling lists. I actually took driving for dollars approach, finding distressed apartments. And that very first 46 unit deal saw it was distressed, went to the public record, saw it was owned in an LLC, skip trace the LLC to find who the owner was, and then gave them a call. Just pick up the phone and very transparent, say interested in purchasing your property. And that very first one this just happened to be their very last apartment they were looking to sell. And interesting enough, they were shifting from being an operator to a debt collector to chase those people who were behind in rent. And it was just good timing to where they were motivated to sell.
So walk us through that process again, because I know a lot of the listeners are in this phase where they're kind of trying to figure out how to find that first property. So obviously you mentioned the service Reonomy, right, which I know is a paid service. I know they have a free trial. You could certainly reach out to them. Tell them you heard about them from the Multifamily Investor Nation podcast. Maybe we'll get a sponsor out of it, you know.
Nice.
But you're using the Reonomy software, and in what way? Like, well, how are you actually figuring out and using some of their filters to get down to the kind of the core property that you're looking for?
Yeah, so when first started, when we were making both my partner and I at the time were shifting from single family to multifamily, we didn't want to put the capital towards a database such as CoStar, which is one of your sponsors, or even Reonomy. So we took the driving for dollars approach. But now with using a source such as Reonomy, we'll use their filtering system to where I'll look for, and even with these databases, this is one little golden nugget for your audience is, even with these data providers is their data is good, but you still have to go the extra mile, because even though you put an apartment or a multifamily between 75 to 200 units, there's still some that fall through the cracks that could be under one unit, but it could be a 300 unit apartment complex. So that's one little gem is really combing through all that data. But I'll go through it, and then I'll look for the ones that haven't sold within the past 5 years as a way to filter it down. That's one. And then also we'll have a virtual assistant comb through those now to find the ones that fit that niche that have been built closer to, I would say, 1970 to now 2000, have since adjusted my criteria, and then have those rents between the 700 to 1,000.
So one thing that Sterling said here, for those of you who are listening, is really important, because you can find a lot of people's properties on databases like CoStar or Reonomy that are listed there, and say you have that 1970 criteria to 2000, minimum 50 units or however many units it is, and you have this huge list of, say, 200 or 300, maybe even 1,000 properties that are in a particular area. But then you can say, well, why would I reach out to somebody that just sold their property a year ago, right? Doesn't really make sense, because they're likely not ready to sell. But having that extra layer of filtering that says, as long as that, I want to look at these properties that have not traded in the last 5 years. That helps you really kind of whittle it down to the ones that you really want to focus a lot of your energy and efforts on.
Yeah, you can get someone who is exiting out. They have the 5 to 7 year in terms of their exit plan. There's also someone that could be in a little bit more difficulties, but they're past the stage where there's a prepayment penalty for them to sell. So those are all the different dynamics with that.
So when you get this data, how are you just making phone calls, or are you actually mailing them a certain sequence, or what's kind of your step process there?
So it's a mix of all. And this is one thing I want to allude to everyone. And it's not even just in just in the acquisition side, but it's even broker relationships. This was a huge unlock for me, is that it's all about the follow-up. So normally it takes between 6 to 8 attempts just to get in contact with the person. And then a lot of times they're not interested then and there. There was another deal that I acquired. This was an 80 unit in Louisville, Kentucky, that was direct to owner. It took the 7th attempt just to get in contact with them. They weren't interested, and it took additional 5 months of consistent follow-up to then they shifted from not being interested to being interested. So I used multiple different channels. So I'll send direct mail. I'll send a Rubik's Cube with a small note that says, hey, let's figure this out. There's other creative ones that I recently heard of. This guy that sends a potato to people. And it's completely random, but it's one of those ways just to stay on someone's radar. And let's say you haven't heard from them in a while. You send them a potato, they give you a call, and they're like, hey, did you just send me a potato? And you're like, yeah, I just sent you a potato. But now that I got you on the phone, then there you go. You go back into segue into your pitch.
There's a lot of great ideas that comes with that, what they call lumpy mail. And you can actually Google like lumpy mail strategies. And there's two of them that come to my mind that I've used in the past. And one of them is actually, there's a website that you can actually create these little round, like puck looking things. And it's like a wooden chip, and it has the word TUIT on it. And of course it's a round to it. And you send it to them and say, when you get around to it, put this in your pocket. When you get around to it, give me a call,
Love it.
Those chips are easy and they're flat. So you stick them on
What is this website? Do you have the website?
I'll have to look it up and I'll send it to you, Sterling, because I don't remember the name of it, but I've definitely used that and got some, good feedback from that. And then another one is you can actually send a plastic, like smaller plastic trash can. And inside of it, you can say, I decided to go ahead and throw this letter in the trash since that's what you've been doing with my prior letters, right? And again, it just gets them to be engaged, and you have to have that multi-step sequence. I think one thing that you hit there was really important for the listeners is that it takes usually 6 to 8 attempts. And can you imagine following up, 5, 6, 7 times, and then you stop. And then it's like, if you would have just done one more, and that would have been that 8th one, and that would have taken you to that next level. And I think that's where a lot of people falter is not even just in the acquisitions process, but even in reaching investors, is that you have to have those multiple contacts and attempts. And until you can get to that number in their head is when they actually start to reach out to you. And I see so many people, and you probably have as well, since you have your own podcast, is you've been interviewed on other podcasts, and all of a sudden they do 20 or 30 episodes, and then they like to stop doing the podcast, or they delete the podcast. And then you're like, well, wait a minute, there's no consistency there, right?
Exactly.
They do more with it. They think it doesn't work, but you have to be consistent with it. And that's exactly what you're doing here.
Yeah. And most people don't even make the initial call, but as you mentioned, it's consistency is key. No matter what channel that you use, all the channels work. People have made them work, but it just comes down to them. Let's say you're doing the direct mail, that most people send 1 or 2 direct mail pieces and say, the direct mail doesn't work. But it's, hey, you got to be a lot more consistent with using that channel.
There's a book out there that I just finished reading called Giftology by John Ruhlin. And I would suggest the listeners reaching out and buying that book on Amazon, because it does give you a lot of good strategies for, it's more on the line of like gifting. So to kind of penetrate through somebody's,
so value.
desk, to get in front of them. Yeah. And so we actually use the strategies to be able to gift our investors for investing. But in this particular strategy, one of the things that they suggest is using like really nice high-end knives, like Cutco knives, and have them personally engraved and say, I wanted to send you these set of knives to try to cut through all the clutter, right? And so you're kind of cutting through, but it's personally engraved with their family name on it. So it obviously would create some additional value for them. So there's a lot of different unique strategies with that. One of the things I wanted to shift to real quick here.
There's no double-edged sword with that, though. Someone receiving knives.
There could be. Now, from the investor's perspective, I think it benefits even more, because when an investor spends, they don't spend $100,000, but they invest $100,000 with you. If you give them a nice set of knives to use at home that are not cheap knives, these are not something they're going to throw away, and they don't have your company name on it, but they have that particular investor's name on it. They're going to keep it around their kitchen, and guess what? Every time they use that in their kitchen, they're going to think about you. And when they have family and friends over, they're going to ask questions. It'll be a conversation piece around the dinner table as well.
Love it. It's dropping bombs.
Well, one thing I wanted to ask about with Reonomy, because it's probably one of the biggest complaints that I see about their service, is how accurate is the data when it comes to the owner information, whether it be the mailing address or even the phone numbers that are provided for those owners?
It's very hit or miss. And the same thing with CoStar. They're one of the largest providers. I was sitting down with one of their reps in one of the properties I have here in Indianapolis, and I said, could you pull this specific property? And I had owned that property that I was sitting in for close to about 1.5 to 2 years, and it still had the previous owner's contact. So that's just a prime example. I said, do not put mine in there, by the way. But that's just a prime example but that's just going the extra mile and doing the digging, because a lot of people will just stop there. And that's one thing that I'll get to. The 156 unit deal, going the extra mile with doing the additional research, is what gave us the upper hand over the competitors.
Do you ever use any skip tracing services or anything like that?
Yeah, so use Ben Verified is always the go-to, and that is BEEN verified.com. Not affiliated with them by any means. That's just, I like the paid services. There's also free ones like truepeoplesearch.com, but that data is not as good as you would get with a paid one. I think there's TLO is another one too, but I like Ben Verified personally.
Share with the listeners, what is skip tracing? Because I'm sure some people are going, what is skip tracing?
So skip tracing, if I wasn't an investor, I would be an FBI agent, just due to all these different. So in essence, skip tracing is when you're looking to find someone's information. Let's say you have an email or a phone number or a primary residence, you would type that into a database such as Ben Verified to get, if you have one, let's say you have, hopefully their name is not as common as John Smith, but let's say it's Sterling White, for instance, and you know that they're in Indianapolis, you would type that into Ben Verified, and then you would be able to find my contact information. And then let's say you type that into a Google search and you're not using Ben Verified and you find my number and you want to find my primary residence, then you could go to Ben Verified and put in the number, and then the rest of the information could come up.
And are you now using and teaching your VAs how to do this process, or are you still doing that?
That is all now delegated.
That's awesome.
To virtual assistants.
And that could be a whole other podcast episode on how to really leverage the virtual assistants to be able to save a lot of your time.
And the thing was, for the longest time, I was doing all that work myself along with everything else that I was doing with the business. So acquisitions, this is what brokers do on the full-time basis. And I had everything else. And I read a book called Predictable Revenue, where the VP of sales in Salesforce, I replicated their system to build our acquisitions arm. So for the longest time, I was working in it versus working on it.
Well, and I think that, getting started, it's one of the best ways to get started is to actually work in the business, but so that you can know how the different pieces move and where you need to put the systems in, the processes. That's one of the things I've done as well when I've started to build out my businesses, is doing it first and then building on people on the back end to be able to help you so that you don't have to do all the work eventually. So I like that, where you start off working in it and then eventually get to the point where you're more working on the business and not always in it.
And you've got the context too. Versus if you don't have any context, you bring someone in, So when I'm speaking and doing the role play with the team, I can understand where they're at because I've been there.
Yeah. You can say, I've actually done exactly what you're doing. So don't tell me it's blah, 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 blah. I know.
I know the objections that come up and
So let's get back to this deal. I know we kind of went on a tangent there. I think it was some great golden nuggets throughout that conversation. But let's talk more about this 156 unit. You got it, obviously, direct to owner, off market, no brokers. So I'm assuming you were the only one making an offer on this project, correct?
Yes, that is correct.
Okay. Mm-hmm. Did you have to, or let me ask you this. Did they accept your first offer when you submitted it?
They accepted the verbal. And I made $1 million mistake on my side because I was too aggressive on the rents by $50. So you think of $50 across 156 units times 12 months. So the conversation after going to them and saying, hey, we're actually so we were originally at 7 million in terms of purchasing and ended up selling at 6.2.
So 7 million original offer, made a little underwriting mistake there, but then we're at 6.2.
Correct.
Final. And did you have to put any earnest money up?
Yes, had to put earnest money up on that.
And how much earnest money was there, and was it non-refundable?
It was refundable.
Okay.
It was either 50 or 75,000.
Okay.
So I don't know
50 or 75. And was it a typical 30-30, or did you have additional options for extensions and things like that built into the contract?
Yeah, it was a 30-day feasibility period, and then it was a 90-day closing.
Okay, great. Now, why did you give yourself 90 days to close it? Was it more of a lender issue, or what was the process there?
So on the front end, the financials, they had to piece those together. It was a mom and pop operator, and we knew we were going to have some difficulties with getting all the financials in piece. And then there was tons of coordinating that we had to do back and forth. So we knew that we needed a longer grace period in order to get this closed. And then also this was the largest raise by double.
Wow. So on this particular one, at what point throughout this process did you actually take the time to actually go and tour the property? Was it before you offered it? Was it in the middle, or was it at the end, or kind of walk me through that process?
So the most funniest story is, since I was born and raised here in Indianapolis, is as a kid, about 15 or 16 years old, I used to visit a friend there and never would think one day that I'd be owning the property. So yeah, so that I just wanted to share that to people, hey, what's possible. And in terms of toured it before actually giving the verbal offer.
Okay. And so walk me through the beginning though, because how many times did you reach out to this particular seller before they actually gave you the time of day? And was it a phone call that eventually did it to them, or did they eventually call you from a letter? What was that? Walk me through that.
So it was a phone call, and it was a huge spider web in terms of.
They call you, or did you call them?
Oh, call them.
Okay.
So this was about a year and a half ago when originally made the initial touch and just didn't have much success in terms of getting in touch with the decision maker, and then kept following up. And then finally one day was able to get in touch with the right person who actually did what was one of the people who put the syndication together about 2 decades ago. So
Wow.
there was people who had passed away. That's why there was a lot of like spider webs that were through that. But then this was through the skip tracing that I was mentioning. Is the one of the people that I found had a very unique last name, and I Googled that and found someone that was in real estate in Florida with that last name, and then ended up giving him a call. He said, yeah, I actually did put that syndication together. And then that's when we started the dialogue.
Wow, that's cool. That's cool. And so you called this person up, started that dialogue back and forth. So you got it under contract eventually, and then now you're in the kind of this due diligence or feasibility phase. What kind of issues did you have come up during that 30-day period?
So the main one was the water. There was slab leaks that we made an assumption on, because when you're looking at the utilities for that property, the water was abnormally high than what it's normalized and supposed to be. So that was one thing that we had to assess. And then also the roofs was something that we thought that we were going to be able to salvage some of those. But essentially the contractors got up there and said, you need to replace these right after you acquire it. There's no prolonging this by any means. And I would say those were the main things through the due diligence. There was no absolute red flags by any means.
So were those 2 items that came up, were those items that the lender also required you to fix after you closed?
Yes, correct.
Okay. And so were you able to get those in place and in order to be able to raise the funds to be able to do that?
What was that question one more time, Dan?
So were you able to raise the funds prior to be able to close? Obviously, did you have enough CapEx to be able to kind of, support that?
Oh, yes. And this was a learning lesson from other deals, is to always raise and create a buffer in your underwriting to take care of unforeseen things. So yes, to address that. And actually, after closing, the original quote that we got from the contractors, so our construction manager, so there's a total of 16 buildings, of which 4 of those are flat roofs and the remaining are pitch roofs. And our construction manager received the bid, but did not take the quote that he received. He thought had all the roofs, but it didn't include the flat roofs. So we actually went over budget on that.
Yeah. And I'm just trying to think here. Were you able to go back and renegotiate a lower price because of some of these items, or was it not significant enough that you had to do that?
It wasn't significant enough. And that was found out after it was acquired. Yeah.
Okay. And so how much CapEx did you have reserved on this when you acquired it for 6.2, but then that CapEx is on top of that?
So the interiors were 9.5. And then the exteriors with the landscaping, the signage, the roofs, that was 3.5 thousand. So all in 12.3 per unit, or 12.5 per unit.
Okay. I thought you were saying 9.5 million there. I'm like,
oh,
what?
No, excuse me.
That'd be pretty expensive renovation.
The total amount that was raised for this project was $2 million towards the reno.
Okay. All right. So that was 2 million total. So all in, you're at 8.2.
Correct. Exactly.
Okay. 8.2. And how did you end up financing this deal?
This was through a regional bank, one that we've had relationships with. And it was 30% of 70% of the purchase price they provided in a loan with 3 years interest only. I had to see. Let me see if I have that pulled up. I do not have that pulled up on the back end. It was either 2 to 3 years interest only. On this one, I would have to say 3 years interest only on it. And then my partner and I raised cash to take care of the down payment, and then also improvements from investors.
And what kind of interest rate did you get on this one back in November?
4.15.
4.15%.
8-year term.
8-year term?
And it's fixed. And it's AM over 30 years.
Okay. And was this recourse or non-recourse?
So through the interest only period, it is recourse, and then it shifts to non-recourse.
Okay. That's unique. I don't think I've seen that before.
I did not see that before. And the regional bank that we went with, that was the first time I've ever experienced that. And that was on the other deals too. And what they're starting to do is, especially in current times that we're in now, is getting more aggressive on their terms to compete with the agency debts.
Mm-hmm. Yeah. Well, that's interesting. So you went with a local regional bank, recourse and non-recourse, 4.15% interest, 8 years fixed, 3 years IO, 70% loan to value.
Correct. Exactly.
Great. Did you have any issues during the financing portion or with the lender?
No, it was pretty smooth process. And that's why we enjoy working with this lender in particular.
Yeah, great. And how did you structure this deal with investors?
85-15. So just straight equity split.
So straight 85-15. Any preferred returns?
No preferred returns. Have shifted away from that. So just keep it simple in our model, and we just do straight equity.
And on this 85-15, you raised approximately, let's see, 6.2. Probably about what, 4 million?
Let me pull that up right now as we speak, because it was closer to about $3 million. I'm actually going to pull that up right now. All right. Okay, come on. There it is. Okay. Boom. So the total amount that was raised was 2.6, because there was a portion of the improvement loan that actually came from the lender.
Okay.
So 1.3 came from the lender in terms of improvements.
Okay, well, that's great. So you had like 70% loan to value, but then you had an additional 1.3 that came on top of that for future.
That is
CapEx.
correct. Mm-hmm.
Now, do you know on this particular one, do they start charging you interest on that 1.3 from day one, or just when you draw it down?
Ooh, I'd have to dig into the specifics on that, because I was more on the acquisition side. And then my partner is more on the actual nitty gritty, the underwriting. So that's a great question. And also to revisit what you mentioned. So it's an 8-year term, 4.25 was the interest rate. And then it is 3 years interest only.
Okay, great. All right. And so you raised 2.6 million. How many investors did you end up having in this project?
Closer to about 50 on this specific one.
So 50 investors. And what was the minimum on this one?
25,000.
25. And how did you end up finding these investors?
All through, and this is a whole personal branding side. So one is we did a partnership with a group that brought a portion of the equity to the deal, but more of both my partner and I, our relationships that we've had with our previous deals, but more so myself, I've been taking the personal branding route. So putting myself out there, I'm a contributor to biggerpockets.com, being on podcasts such as this as a lead generation to then funnel to the company for people to register and then convert them to an investor. So investors across the country, international, et cetera.
So how many, not how many. So what did you do when you first put this deal on the contract? How soon do you announce it to your investors, and how long does it actually take you to typically raise the money for a deal like this?
Yeah, so as soon as we were under contract on this specific one, we did announce it to investors. However, we just keep them in the loop that, hey, we're doing the due diligence on this deal. And once we get through the due diligence and see that it's confirmed on our initial underwriting and that we have the green light, there's no retrading that we have to do or anything, that's when we start to raise the money.
Okay. And how are you usually communicating with your investors throughout this process?
So one is we're communicating, we're having phone calls. In addition to that, once we do have the green light on it, we do conduct a webinar, in which is just an overview on the project. And then investors come on and do Q&A, and then primarily is also through email as well.
Okay, great. And what do you do once an investor is in the project, like post-closing? Like how soon does it do distributions usually start, and how is your communication like after you close on a property?
Yeah, so the way in terms of our payments is it's on a quarterly basis. So if someone invest, let's say January, and there's 2 months in terms of the end of the quarter, so they would get paid as soon as essentially as soon as they start investing. So that's how that work on that. In terms of communication, it's on the monthly basis with the updates. And that's more on my partner side that handles the asset management with providing them the necessary updates of, hey, we're actually ahead of schedule. We're actually doing well. And in today's climate, that one thing that we were nervous about is collections, which collections have been closer to 95% in collecting the rents. So that's been good.
Yeah. I think that's great. I think right now, we're in the middle of COVID-19, so we're recording
I
this
didn't want to date
in the middle of May. So
Yeah.
there's definitely been some over communicating that a lot of people have been needing to be able to do for their investors. Actually, what we did with our investors and that are in our projects in April is we actually sent out a weekly Monday report to them every week to update them on how the collections were. And then in the month of April, because they actually went really well in April. We actually decided to go to bi-weekly in May. And so we're doing two. Normally we just do like you do, Sterling, where we're just once a month updating them on how the property performed in the prior month. And investors are usually great with that. And the good thing about that is, that when you have those monthly communications, you can talk about a lot of the good stuff that's happening, but you also have to talk about the bad stuff, right? Like if something's not happening right, there's a water leak or a roof or whatever, you got to talk about that stuff so that your investors are aware of it as well. So it's the good, the bad, and the ugly,
Yeah, because you wouldn't want them to find out the ugly portion without you indicating that that's just not good in terms of that relationship. Because what I've experienced with all the deals is investors repeat. And so with that, they tend to repeat and stay with you for the long term. So if you burn that bridge by just not being transparent, then that's not good. And that's not a reputation that you want to have.
So at the end of your deals, when you go to sell them,
Refinance.
what's your plan?
Refinance is the first one, and just return all the investors' cash back, all, if not most of it. And then in the event that they have all their cash out of the deal, that they'll still be earning that reoccurring passive income on that side, just on infinite, because they have no cash that's in it.
Mm-hmm. And so your goal is to really kind of refi them, not out, but refi their money out so that they have no money invested in it, but they're just going to hold on to it in perpetuity. So there's no real plan to exit it in the short term.
Correct. Exactly. And it's on a 5 to 7 year hold period. And we also do have into consideration, like on this specific deal, this is what it would look like in 5 years in the event if we were decide to exit a 9.8 purchase price, and you're looking at XYZ in terms of your IR. So we have that in terms of our calculations, but we also have separate ones that say, hey, this is our number one priority, or our number one business strategy is to actually refinance.
Yeah, no, that's great. And so when you do actually sell, are you considering to try to bring your investors along and try to do a 1031 exchange to the next asset? Or if you sell, do you just completely take your investors out and just sell the asset?
Yeah, it would be sell and completely exit. So that very first 46 unit deal ended up going full cycle on that. And it was actually great timing, because that deal sold as soon as this one, we started raising money for it. It must have been the universe in that way. And so we ended up had several of those investors just reinvest that, but there's no 1031 with our specific deals.
Okay. And last question, not last question of the entire interview, but I'd say the third to the last question I'm going to have for you is, because I have two final questions that I always ask every one of our guests, but can you think of anything else, any issues or problems or things that maybe the listeners might need to be aware of that that happened during this acquisition that you think would be helpful?
I would say always just expect the unexpected. I always indicate that to people. And one mistake I made on the previous deal, this was my second one, was assuming that I would the deal was already tight from the get-go, and not raising enough cash to be able to take care of those CapEx items, and took the rationale that the CapEx could come from the cash flow. Huge no. And I remember hearing that from others on podcasts, and decided to do it anyway, and actually had to exit out of that deal, and actually still did pretty good on it. However, it was just one of those learning lessons that if I was in a time such as this, where there wasn't ideal in terms of being able to exit, then that wouldn't have been good.
Mm-hmm. So final two questions for you, Sterling, before our time is up here today. The second to the last question, these are two contrasting questions, okay? So first question is what did you find that was easy during this entire process that maybe in the beginning you thought was going to be a little bit more challenging?
I would say raising the money. So it was the 2.8 that was needed to close, and it wasn't as bad, and that was double. So normally
That
was
was
around
twice
about,
as much as you had done before.
yeah, that was, so the average amount was 1 to 1.2 million before that, and I expected that double that there would be some issues with it. So in essence, ended up didn't have all of the funds in the the bank account to be able to close. However, was able to float some cash from our primary business in essence, and then post closing was able to fund that remaining. So there was that. It wasn't as difficult as anticipated. And another one is that you can still go to direct to owner and buy deals on larger assets. I believe the even more larger you go, it gets even more difficult because you've got more sophisticated operators and say, I'll just put this on the market. Why would I sell to you and I can get top dollar?
Yeah. I think that's the distinction that you have to look for when you're trying to find these deals off market on these larger acquisitions is try to find what you found, which is that kind of smaller mom and pop operator. Even though it was a syndication group that probably put it together in the beginning, like you mentioned, there was definitely some smaller mom and pop aspects to this. And instead of them going direct to a broker to try to get top dollar, they were just like, hey, this is the easy button. Let's press it. Let's sell it and get out of this deal.
Yeah, and also it's all sales. Had to sell those guys on the largest deal before that was 80 units, and there was two 80 unit deals, one in Louisville and another here in Indianapolis, but never acquired something that large in that race. So it came down to sales that, hey, we'll be able to get it done. So that's one also learning lesson for everyone, that even when you're buying, you're still selling.
Yeah. No, that's a very good distinction there. Last question I have for you here is kind of the opposite of that. What did you find was harder than you had originally expected that you thought might have been a little bit easier?
Gosh, dang it. Okay. What was harder from that standpoint? I'm trying to think what was more difficult. Mm, I can't think of anything right now, Dan. I know there's something. You put me on the spot with that one.
Well, when it doesn't come to your mind, it must not have had that big of an impression. So that's actually a good thing. So there doesn't always have to be an answer to that, right?
Yeah, I know there's something. It's not popping in my head though.
Well, I want to thank you so much, Sterling, for coming on to the podcast here and sharing a lot of these different, knowledge tips and golden nuggets throughout the entire interview. And I'd love for you to tell the listeners how they can reach out to you if they have further questions about this deal, or maybe you want to join you on some of your future opportunities as well.
Yeah, so sonderinvestmentgroup.com is the company. And also if you want to follow me on Instagram, it's Sterling White Official. And at the end of the day, here to be of value. So don't ever hesitate to reach out with any questions, or on social media, slide into the DM, which is direct message for those of you who are on here.
Well, thank you again so much, Sterling, for being here, and looking forward to having you on a future episode as well. I love interviewing you and your energy. It's been great, and look forward to having you on a future episode as you continue to close more deals.
All righty. Have a great one, everyone, and keep being awesome.